Feeling like you work incredibly hard all month long, only to check your bank account and wonder where it all went, is a distinctly modern kind of exhaustion. You pay the rent, you pay the electric company, you pay for groceries, and you promise yourself that whatever is left over will finally go into a savings account. But somehow, by the time the 28th of the month rolls around, that leftover amount is almost always exactly zero. The traditional advice often tells you to simply budget better or cut out your morning coffee, implying that financial stability is purely a matter of daily, grinding discipline. Financial experts know this is a fundamental misunderstanding of human behavior. Relying on sheer willpower to save money after you have navigated a full month of unexpected expenses, daily stress, and highly targeted marketing is a losing game. You are setting yourself up to fail before the month even begins. There is a profoundly simple behavioral finance principle that flips this entire dynamic on its head. It is called the pay yourself first strategy, and it changes the fundamental order of your money management. Instead of hoping for leftovers, you treat savings as a fixed, non-negotiable expense. You make your future self the most important bill you pay, placing it ahead of everything else in your financial life, including your immediate comforts and daily conveniences. Making this structural shift removes the heavy burden of guilt and constant decision fatigue from your daily life. When you prioritize your own financial security right at the top of the month, the anxiety of the end-of-month scramble simply vanishes. You no longer have to negotiate with yourself every time you walk past a store window or open a food delivery app on your phone. The heavy lifting of wealth building has already been done behind the scenes. To actually make this work, you have to completely bypass the willpower trap by making the process entirely invisible. You achieve this through automated systems, usually by splitting your direct deposit right at the source. If your employer allows it, you can route a specific percentage or a flat dollar amount directly into a separate savings account before the rest of your paycheck ever hits your primary checking account. If your payroll system does not offer that direct split feature, you simply recreate the exact same effect through your banking portal. You schedule an automatic transfer to execute on the exact same day your paycheck clears. The money moves instantly, vanishing from your daily spending view before you ever have the chance to mentally claim it as available cash. The ultimate goal is to make the transfer happen without requiring a single manual click from you. A fascinating psychological shift occurs when that money is no longer sitting visible in your main checking account. You naturally adapt to the new, slightly lower balance, and your household spending organically adjusts to fit what is actually in front of you. It is the exact same way you adapted to paying taxes out of your paycheck. Because you never see the money, you never truly miss it, and you learn to live comfortably on the remainder. This invisible habit integrates perfectly with proven frameworks like the 50-30-20 budgeting method. By automatically routing that 20% towards savings or debt payoff immediately, you guarantee your most critical financial goals are met first. The remaining 50% for needs and 30% for wants can then be spent without the lingering guilt that you are somehow shortchanging your future. The budget transforms from a tool of restriction into a tool of permission. A common fear when starting this is that taking money out first will leave you short for your actual living expenses. But treating your savings like a bill forces a healthy kind of scarcity that clarifies your true priorities. If the math truly does not work after paying yourself, it exposes a structural issue in your lifestyle costs rather than a lack of discipline. It forces you to confront the reality of your living expenses head on. You do not have to start with massive, intimidating amounts to see the immediate benefit of this system. Begin with just $20 a paycheck if that is all your current situation comfortably allows. The initial dollar amount matters far less than establishing the behavioral pathway. Once the automated route is built, increasing the amount later takes only seconds, but building the initial habit of paying yourself first is the most critical hurdle to clear. That small, consistent trickle of money is exactly how a robust emergency fund is born. An emergency fund is simply a stash of cash set aside specifically to cover unexpected financial shocks, like a surprise medical bill or a sudden car repair. When you prioritize yourself, that safety net weaves itself together quietly in the background, transforming what could be a major financial disaster into a minor, manageable inconvenience. The security of having that cash buffer fundamentally changes how you sleep at night and how you interact with your family. The ambient stress of living paycheck to paycheck begins to lift, replaced by a quiet, steady confidence. You stop dreading the mail carrier or the sound of the car engine making a strange noise. The automated system has effectively bought you a thick layer of emotional armor against the unpredictability of daily life. This same frictionless strategy is remarkably effective for dismantling high-interest debt. Instead of routing the automated payment to a savings account, you direct it straight toward your highest interest credit card. High interest is driven by your APR, or annual percentage rate, which dictates exactly how much your borrowed money cost you over a year. Whether you use the debt avalanche method to target those high rates or the snowball method for quick psychological wins, automating the extra payment guarantees steady progress against your balances. There will inevitably be months where inflation spikes or holiday expenses loom large, and the temptation to pause the automated transfer will be incredibly strong. Consumer culture is explicitly designed to separate you from your money, constantly urging you to prioritize immediate gratification over long-term stability. Pausing the system feels like an easy pressure release valve in the moment, but it breaks the very consistency that makes the entire strategy work in the first place. To protect your progress during those tight months, you must treat that automated transfer with the exact same reverence you give your rent or mortgage payment. You would not simply skip a housing payment because you wanted a new television or a weekend trip. Your future financial stability demands that exact same level of unwavering commitment. You have to defend your own wealth-building system fiercely against both external pressures and internal temptations. Navigating this approach with a variable income or a freelance gig requires a slightly different tactical approach, but the core philosophy remains completely untouched. Instead of automating a fixed dollar amount, you commit to a strict percentage of every single deposit that hits your account. If you earn $500 one week and $2,000 the next, the percentage ensures your savings rate scales perfectly with your fluctuating cash flow. One of the most effective ways to reinforce this boundary is to hold your savings at a completely different financial institution than your primary checking account. When your safety net is housed at a separate bank, it typically takes 2 or 3 days to transfer the money back to your main account. That slight friction serves as a powerful cooling-off period, preventing you from raiding your hard-earned savings for a fleeting impulse purchase. Once your immediate safety net is fully funded, the mechanism naturally evolves into your primary wealth-building engine. The automated transfers simply shift their destination from a basic bank account toward investment vehicles like a 401k or an individual retirement account. This is where your money stops merely sitting safely and actually begins working tirelessly on your behalf, capturing the long-term growth of the broader economy while you go about your daily life. By consistently funneling money into broad market index funds, you unlock the mathematical marvel of compound interest. Compound interest is what happens when the money your investments earn begins to earn money of its own, creating a massive snowball effect over decades. Because your contributions are automated, you are constantly buying into the market regardless of whether it is up or down, entirely removing the stressful guesswork of trying to time your investments. Watching those balances grow over the years without any active daily effort on your part is a profound realization. You begin to see that building wealth on a normal income is not about hitting the lottery or making risky speculative bets on the stock market. It is simply the result of modest, consistent actions repeated over a long time horizon. The invisible habit slowly transforms your entire financial trajectory from precarious to prosperous. When you decide you want to accelerate this timeline, that is when you might look toward income diversification through a side hustle or freelance work. But rather than letting that extra money bleed into your everyday lifestyle inflation, you apply the exact same uncompromising rule. Every single dollar from that secondary income stream gets swept immediately into your automated wealth-building system, supercharging your progress without changing your baseline living expenses at all. The downstream effects of this discipline eventually touch every single corner of your financial life, including your ability to borrow affordably. As your cash reserves grow and your reliance on credit cards shrinks, your FICO score naturally improves over time. A FICO score is a 3-digit number lenders use to measure your credit risk, and a higher score unlocks significantly lower interest rates on major, life-changing purchases like a reliable car or a family home. Preparing for major life events like a wedding, a cross-country move, or a child's education suddenly becomes a matter of simple logistics rather than a source of deep panic. You just open a targeted savings bucket and set up a brand new automated transfer. The strategy scales effortlessly to accommodate multiple competing goals, allowing you to fund your dreams methodically rather than financing them through stressful, high-interest personal loans. There is a persistent cultural myth that you need to be wealthy before you can start managing your money like this. The reality of personal finance is the exact opposite. You do not wait until you are financially secure to start paying yourself first. Paying yourself first is precisely the mechanism that makes you financially secure. It is the foundational step that elevates you out of the exhausting cycle of living paycheck to paycheck. Reclaiming control of your income in this way is one of the most empowering actions you can take for your future. You are actively rejecting a system that wants you to spend every dime you earn on things that lose value. By prioritizing your own stability over immediate consumption, you are building a quiet, unshakable resilience. The automated transfers become a silent testament to your commitment to a better, more secure life for yourself and your family. The path to financial independence does not require a flawless budget or superhuman willpower. It only requires the courage to restructure your cash flow once, making your future self the most important creditor in your life. Take 15 minutes today, log into your banking portal, and set up that very first automated transfer. Let the system do the heavy lifting, and watch as your financial reality begins to permanently and positively change.